A very good
Recording
evening
in
to you all,
progress.
friends. I'm Sanjeev Singhal, Chairman, Sustainability Reporting Standard Board and the Auditing and Assurance Standard Board. I welcome you on my behalf and on behalf of my Vice Chairman, CA Vishal Doshi ji, to this very important webinar on analytical procedures and auditing accounting estimates, including fair value accounting estimates and the related disclosures. Friends, we have started this initiative of capacity building, and these initiatives are going for long now. In this year, we started a series on the various auditing standards since the first week of April, because these 45 to 60 days are the peak audit season period. So we are trying to cover all the auditing standard in this period. In fact, most of these standards have already been covered. And now, once all these standards are covered, we'll be moving to the guidance note on CARO, then Rule 11, E, F, and other related matters which are important while carrying out the audit procedures. So this is our 32nd program in this council year, which started from 12th of February, and more than 26,000 members have attended these programs. Even now, more than 1,000 members have already joined. And friends, let me also tell you that as a measure to support our members, this time we constituted 2 expert panels. One during the bank audit, which was operational from 1st April to 15th April, whereby members could ask their queries on bank audit and there were no charges for it. And then an expert panel for queries relating to the statutory audit. And this expert panel is functioning from 16th of April, and this will go on up to 30th of September. So if you face any audit issue, you want to consult an expert, and this audit issue can arise in the course of your statutory audit of companies or partnerships or proprietorships. You can ask our experts that question. These experts will answer. And of course, I mean, you will have to apply your judgment while giving your final audit report. But this is the world's biggest initiative because this covers about 14 lakh companies and lakhs of the partnership firms as well, which undergo the audit. So members are welcome to avail these services. There is no fee for the same. And experts who wants to help us in answering the queries are also welcome to join us. We have already enrolled more than 50 experts who are answering the queries day in and day out. Our expectation from the experts is that they will provide 3 hours a week for any 10 weeks during this period. Friends, now coming to the topic for the day, we'll be covering SA 520 and SA 540. SA 520 talks about the analytical procedures, and Amit Chugh will be taking this session. Analytical procedures are very important because, see, when you are doing the routine audit or when you are doing the control testing or the substantive testing, you do not get a holistic idea about that particular item of financial statements. For example, if revenue has gone up or gone down, or what's been the monthly trend in revenue, how it compares. So over a period of time, say maybe 3 years or 5 years. So this matters a lot. So analytical procedure provides useful insights to the auditor. And in a way now, analytical procedures are also mandated by law because in Schedule 3, 11 ratios needs to be given. And if there is a variation of more than 25% in the ratio as compared to the previous year, then suitable explanation also needs to be given. So they have always been an important tool available to the auditors. The next standard that we'll be taking in this webinar, and normally we have been taking 2 to 3 standards only in a webinar, that's auditing the accounting estimates, including fair value accounting estimates and the related disclosure. And this session will be taken by CA Pratish Amin. Friends, estimates are very, very important because at so many places a management has to apply judgment, exercise judgment, and estimate. For example, when you make a provision for doubtful debts or the expected credit loss, it's an estimate. When you make a provision for obsolescence of inventories, it's an estimate. When you measure the inventories at lower of cost or net realizable value, The estimate, the net realizable value is also an estimate. When you charge depreciation, when you estimate the useful lives, estimates are involved in many items of financial statements, and they needs to be exercised carefully. The management will make the estimates and the auditor will evaluate those estimates. And then with the advent of Ind AS, fair value accounting is also there, and the fair value accounting estimates could be pretty complex. An auditor would need to exercise extra diligence and care. Friends, I'm very happy to share that today we have with us our Honorable Past President, C.A.K. Agarwalji, as a keynote speaker. It is difficult to introduce K.M. Agarwal sir in a short span of time, but I'll make a sincere attempt. Sir has been a past president of our alma mater, our ICAI, in 1990-91. He's also been a past president of SAFA. So he was the president of SAFA in 1990. He's been a member of the executive committee of CAPA, Confederation of Asia Pacific Accountant, in 1990. He represented the country on the council of the IFAC from 1992 to 1995. He's been also a chairman of the NIRC of ICAI. He's a senior partner in KM Agarwal and Company Chartered Accountants since 1969. And he's been a co-author of Ready Referencer to Income Tax Law in Circular. Besides, he's a Bachelor of Commerce from Allahabad University and was awarded the prestigious Chancellor's Medal for being the best student of Commerce Department of the university. So thank you so much for being with us and agreeing to be a keynote speaker. So we would request you now to deliver your keynote address. Thank you.
Thank you, Sanjeev ji. CA Dr. Sanjeev Kumar Singhal ji, Chairman, Auditing and Assurance Standard Board, Vice Chairman of the Board, Mr. Vishal Doshi, the very learned speakers of the day, Mr. CA Amit Chuk and CA Pratish Amin. I'm really happy and feel it a great pleasure to be here this afternoon and to say a few words just about the two topics which we have selected for today's deliberation. Dear participants, I'm very happy that Mr. Singhal has enlightened me about various programs of the Institute, various initiatives of the Institute which they have taken for the help of the members during audit and bank audit, etc., etc. I am very happy to know that this is the 32nd program in the series for educating our members, and more than 26,000 professional members have participated in this program. The two subjects which have been selected today, the two standards which have been selected today, are very apt and proper, keeping in view the timings what they are organizing. Since most of our professional colleagues will be finalizing the balance sheet very shortly, or have finalized in a very short time, so these two standards will play a very important role in analyzing the financial accounts of the auditing, as well as various issues where valuation comes in, where estimates come in, and they are very important. Not deliberating much on this subject because it is going to be deliberated by the two very, very learned speakers who are master of this. I would like to say a few things about the Institute and our profession. I think that would be more appropriate to say a few things to the members to this channel, because the subject will be deliberated in detail, and that would be very nice for members. I would not like to intervene or take their time. Sir, the profession of which all of us are members is one of the prestigious professions around the globe. Our institute, which was established long back in the year 1949, is one of the best professional institutes which has an unparalleled record in education, in training, continuing education for professionals, and disciplinary mechanisms. I feel very sad whenever sometime the image of the profession is tried to be maligned by some of our own colleagues, and sometimes by government, and sometimes by other agencies. Our institute, our family has grown very big. It has more than 3 lakhs members, I think, and more around 10 lakhs students. So at some quarter or the other, something wrong is bound to happen. But that does not mean that the profession is not performing well, and any kind of super regulation, whether it is required or not, is a matter of great debate. And particularly whether those regulators should have what kind of qualification and what kind of experience to regulate the profession. When I look into the disciplinary mechanism of the institute, I find that it has one of the best mechanisms available in any of the professions. You go to architecture, you go to profession of medicines, you go to bar council. Our mechanism of discipline is one of the best. There are allegations that sometimes there is a favoritism, cases are pending, but I would like to give some views on this. The institute has got a record in its disciplinary mechanism that whatever decisions and cases it has reported, and they have gone to the court, but in none of the cases, the punishment which has been awarded by the institute has been extended or enhanced, rather it has been reduced. That itself speaks about the standard and integrity of the disciplinary matter. And secondly, so far as some pending cases are concerned, they are bound to happen. Our institute has become very big, and more expectations of the society, from the government, is bound to bring in more cases for disciplinary matters. But to give natural justice and fair expression of views to the complainant as well as to the accused, some delay is very natural. It is not in our case only, it is the case of all the judiciaries, lower court, upper court, but all our institute, our president, vice president, and they are trying their best to solve those cases as early as possible. Third, to go and compare this profession with other professions. We are the only one which always pray for the economic development of the country. We always pray that our clients should prosper. We always pray and educate our clients to comply with laws, to comply with taxation laws, and pay as much as they should. It is the effort of our professions and institute that whatever schemes have come by the government for disclosure, etc., there is a great contribution of our members in educating their clients and bringing them on board. Otherwise, it was not possible. In today's scenario, there is a lot of GST collection. It has gone up very high. Tax collection is going up very high. Compliance rate is also increasing very high. Why so? It is the efforts of our professionals who are trying their best to educate their clients and bring them on board and tell them, look, if you do not comply with the laws, you do not go in proper accounting and of your transactions, the things will not be good for you in future. And that is why they are coming on board and declaring their income to the best, and GST collection has gone. Our institute and professionals, part and parcel of national building, and any kind of attempt and the profession or on the institute to malign its image is not correct and should be taken with an iron hand, and at various platforms, our members, our council members, and the other dignitaries should impress upon it. With these few words, friends, I wish you all a very good professional career, and I am very sure that the deliberations will be of a very high standard and are used to the members in the current scenario. Thank you very much for inviting me and giving me this chance to say my few words about the profession and the institute and about the subject. Thank you, Mr. Singhal, and all the other participants. Thank you.
Thank you very much, sir. For this overall guidance and speaking about the institute. Thank you so much. I'm sure that the participants would be immensely benefited by your perspective for the profession. It's now that we move to our speakers for the day. I invite Amit Chok. Amit is a commerce graduate from the Shriram College of Commerce, a chartered accountant with over 2 decades of experience, currently working as partner with SR Watley Boy. He's been associated with the institute on various forums since 2000. The Ind-AS course started. So he's been a regular faculty, member of the study groups of various committees, member of he's been a technical reviewer with the FRRB. And of course, his areas of expertise are auditing, Ind-AS, capital market transactions, etc. So thank you, Amit, for taking out time, and we'd request you to kindly talk about the topic for the day for you, which is the analytical procedures. Right now, 1,698 members are viewing this webinar live. Thank you.
Thanks, Sanjeev ji, for the opportunity, and Agarwal ji for your kind words. And I think that's a great platform, and especially relevant in today's context. Over 1,600 members is a very outstanding achievement in the current context. So I'll just share my screen, Sanjeev ji, if you could just let me know when the screen is visible.
Yeah, the screen is visible, Amit. Screen is visible. Yes, it is visible. SA 520.
All right. So I'll quickly introduce the standard. So today we'll be doing SA 520 on analytical procedures, and I think I'll start from the keynote address that Agarwal ji shared. We spoke about the regulator and the regulator expectations today. So I think 2 things. I mean, I've been involved in audit for 21 years now, and there are 2 things that have changed, or I would say evolved, in last 2 decades. One is the regulator involvement and expectation from us as auditors or the audit profession. So that has increased, changed enormously in last, I would say, more particularly in 10 years. And second, businesses today have become far more global, more dynamic. And in that sense, given these 2 aspects, considering them, the traditional procedures and routine procedures. So there is absolutely, without undermining the importance of those 2 aspects, so those would continue to be required. Those are essential. However, if we perform only the traditional audit procedures, the routine procedures, those are not sufficient enough in the current context, and hence we need to corroborate these procedures with substantive analytical procedures or analytical procedures. So if I begin this by setting the context in terms of what is the scope. So the scope is that this particular essay deals in auditors' use of analytical procedures as substantive procedures and procedures at the year end of the audit in forming the overall opinion. Now, why we particularly talk about year end? Because as analytical procedures, and given their importance, These are procedures that are used through the process of the audit. You use them in the planning process to set expectations, to create areas of importance as an auditor, and you use them at the substantive procedures at the year end to corroborate the other evidences that we obtain using the traditional procedures. So analytical procedures right now in today's context are pervasive through the course of the audit. Today in particular, we'll be talking about use of analytical procedures for the year-end procedures or the substantive procedures. The objective is to obtain reliable and relevant audit evidence and to make sure that the financial statements are consistent with the auditor's understanding. So now this is very, very important. So today, in today's context again, the audit is not restricted to use of auditing standards and accounting standards. There is an expectation for an effective audit that the auditor would be having an understanding of the entity, understanding of the company's operations, understanding of the industry as well. And the correlation of that understanding that the auditor has with the financial information is something wherein the analytical procedures come into play and the auditor is required to corroborate those evidences obtained. Now, we're talking about analytical procedures, and we'll spend some time on this definition. So the term analytical procedures is evaluation of financial information, because of course the ultimate objective is to issue an opinion on the financial results. So it is an evaluation of financial information through analysis of plausible relationship, reasonable relationships among both financial and non-financial data. So which means while we are performing analytical procedures, we don't restrict ourselves as auditors only to the financial information or the financial data. What would be a financial data? Your balance sheet, profit and loss account, revenue, expenses, all of this is financial data. What are non-financial data? Units of production, number of workers, per square feet area. So some of these are non-financial data, which are key inputs of financial data. Analytical procedures also encompass such investigation as necessary of identified fluctuations or relationship that are inconsistent with the relevant information or that differ from the expected values by a significant amount. We'll look into and we dwell into some of these aspects around what do you mean by expected values? What do you mean by identified fluctuations and their relationship? And what do we do when there is a difference between the two? So we would be dwelling on these in detail. But just to give you some examples of financial items and non-financial items. So if I talk about some analytical procedures, some which come top of my mind would be a gross profit ratio analysis, an input-output analysis, yield analysis. Let's take an example of, say, for example, packing material. So in year one, company had, suppose, sales of 1,000 rupees, and the packing material expense was 30 rupees, which means we had an expectation that 3% of my total sales value is generally the packing expense charge. So we saw this analysis over a period of time. When we go and audit and we see that the packing expenses in a particular year is not 3%, but coming out as either 2% or 4%. So the moment there is a variation and the variation is significant, then you identify that particular variation and use that to design your audit procedures to get a comfort on the overall financial statements. Now, what would one do if the variation, in, for example, in our example of packing expenses is going either high or down? You inquire of the management as to what are the possible reasons as to an increase or a decrease. Now, there could be an instance wherein there was a specific order which required certain special packing. So that could be a possible reason for increase in the packing expense. So that would become your explanation, and then you obtain audit evidence around that explanation that the management is giving you. So analytical procedure is not going to give you a conclusion in itself, but it would direct you to perform a more effective and efficient audit. And it would help you design the audit procedures and help you arrive at a more stronger conclusion. So these are GP ratio, input-output ratio, correlation between a particular expense and revenue, correlation between two particular expenses. All of these are financial items, which means these are coming out of the financial statements. Now, there are a lot of analytical procedures that are done for non-financial items also. For example, number of units produced. Now, that is a very important input that we use for doing several analyses to study, for example, consumption, to study freight cost, and other items of similar nature. Again, a very common example is Provident Fund reasonability. Now, Provident Fund is generally 12%. So while you have to audit, one way to audit, a traditional way of audit a Provident Fund would be that we look at that, is there a challan available for all the 12 months? Has that been deposited in time or not? So that is a traditional way of doing the audit. An analytical procedure to substantiate or to corroborate that conclusion would be that you spread out the PF expense for 12 months. You look at the payroll expense and then see what is the percentage of payroll expense for each month, sorry. Is it coming at to close to 12% or not? Because 12% is what the PF is usually deducted for a particular company. If not, then you delve deeper into it. You identify the reason for variations. So that is a non-financial data that we are using to analyze a financial information. Another example could be number of laborers. So in a contract manufacturing environment or in a manufacturing setup, number of laborers or number of contract labor that is being employed by a manufacturing facility is a very good input that we can use for several analysis. Say, for example, if the number of laborers is increasing and the overall production is going down. So these are two non-financial inputs, but giving you a direction that there is some exceptional item in the current year, because of which, in spite of increase in the number of labor, the overall units of production are going down. So again, these are few examples. There can be multiple examples of both financial and non-financial inputs that help you design your audit in a better manner. So again, I would repeat, an analytical procedure would not give you a result in itself, but one, it will make your conclusion stronger. So whatever evidences that you are obtaining from your traditional audit, from your routine audit, the kind of conclusion you intend to draw from those evidences is much stronger when you corroborate it with analytical procedures. So that is the first important aspect of it. The second is, in itself, an analytical procedure would help you design a better audit. It will help you make an audit program which is more efficient and effective and smartly designed to yield or to focus on critical areas wherein the likely of exceptions is higher. So, and why would we do that? Because if there's an exception, there is a likelihood that there could be a misstatement in the financial statements. So if we direct our audit efforts, our design of audit procedures towards some of these exceptions or design areas which are coming out of the result of our analytical procedures, the quality of overall audit goes up. Now, we'll study some of these things in detail. So these are called substantive analytical procedures. So right now in this particular essay, we are not covering analytical procedures which are being used in the planning process. Those are being covered with a separate essay. So while designing and performing substantive analytical procedures, either in itself or as a combination of procedures, substantive procedure which are designed under 3305, the auditor shall. So these are consideration for an auditor. Firstly, look at that whether a particular substantive analytical procedure is suitable under the given circumstances or not. So suitability could be determined basis two things. One, experience of the auditor with regard to that particular company. So with your prior experience or with your previous year work papers or previous year ratio analysis, trend analysis, and various other aspects, one tends to have an expectation about the company, which would come with the experience on the company. And second factor is experience about the industry. So one could use both an industry experience and the company experience in determining the suitability of a particular substantive analytical procedures. And this would not be pervasive or common for all account captions. This would be different for all account, differently being taken for different account captions. And likewise, within an account caption also, for different assertions, you would apply a different lens while ascertaining the nature, timing, and extent of analytical procedures to be used. The second more important consideration that the auditor has to consider is the reliability of data, which the auditor's expectation of recorded amounts. Now, in a lot of these instances, or in these last three slides, we would have read this term expectation. Now, what is an expectation? Now, while performing analytical procedures, substantive procedures, or test of detail, the auditing standards require, or I would say this is even common parlance also, that one approaches the audit with a set of expectation. For example, in today's context, if I give you an example, if I am going to audit a metals and mining company, I would have an expectation that given the inflation, given the rising metal prices, the revenue would be much higher compared to the previous year. So there is an expectation that I have. Or let's take a different example. Suppose there is an industry for which key input is oil and gas, or key input is a petroleum byproduct. Now, given the high crude prices, given the high global prices, Russia-Ukraine conflict, and increasing prices for the petroleum byproducts, and that being the key input, the auditor would go with an expectation that the margin would have shrunk in the current year because the key input is demonstrating a higher pricing globally. So whenever you are approaching a particular account caption for forming a conclusion as an auditor, whether it is substantive procedures, analytical procedures, test of detail, or any kind of procedure, you go with a preset expectation in your mind, and analytical procedures help you corroborate that expectation, that whether our results are yielding towards that expectation or not. Sanjeev ji made a very valid point about the 11 new ratios that are being introduced in Schedule 3, which go in as a mandatory disclosure. Now, when I talk about all of these ratios, and ratios is a very, very key audit procedure that one performs while performing analytical procedures, and now given it is coming directly from Companies Act, so it becomes even more important. So whenever you are looking at a particular ratio, there is an expectations that we have. For if we take and stretch our example, if the petroleum byproducts have gone up, I would be expecting that the gross profit ratio in the current year should have gone down because my input pricing has gone up. Now, if it is going down in a similar fashion, then I would perform my usual audit procedures and get to a conclusion that the balances are fairly stated. But if it is not going down in the same ratio or going in a reverse direction, then in addition to my usual procedures, I would also have to look at the reason for such an exception. Is there some new products that are being launched? Is there any other reason also for the gross profit ratio to go down? And so on and so forth. The idea is that these analytical procedures help you corroborate the experience or understanding that you already have for that business, or the expectations that you have developed over a period of time, given the market conditions, inter-firm conditions, and other factors. Then comes the third point, which is developing an expectation, which we just now discussed, and this becomes and remains a very, very important aspect. While developing an expectation, this could be intra-firm, inter-firm, or it could be basis a particular event. What can be a particular event? For example, if there was a shutdown in a particular month, for that period, you would expect the payroll cost of contract labor to go down. In that particular month, you would expect the power and fuel cost to go down. For the whole year, you would expect the production units to go down. So again, there was an event that happened. What was that event? Event was a lockdown or a strike by the laborers or any other particular reason because of which a lockout happened. And what would that event lead to? It could have financial impact on various account captions, and we would corroborate that understanding and develop our audit procedures or develop our audit program basis our understanding of inter-firm, intra-firm, and event-based things that have happened during the year to devise specific audit program for specific account caption. And last consideration is, if there is any difference in the recorded amount and the expectation, then you delve deeper into determining as to what are the reasons for such a variation. Again, to take an example, we said that my PF cost has to be 12% of my basic salary cost that is going in. So we would, supposedly I put up the payroll cost and the basic cost month on month, and we do a month on month analysis. So there are two analyses I can perform with this. One, is it coming at 12% or not? And second, is the PF moving in a similar percentage as my basic payroll cost? So now let us think of differences that can come through. The first kind of a difference that can come through is that PF is not coming at 12% of my basic cost. So we would look at the difference and suppose it is coming at 10%. Now, then we would look at differences as to why is it coming at 10%? Is it being offset in the subsequent month or not? Is it on an account of error? Is it on account of a lower deduction? And what could be various reasons? So you evaluate the difference and try and rationalize that whether with the management justification or explanation and the audit evidence that you obtain, is the difference getting explained or not? If the difference gets explained, then we conclude that that account caption is fairly stated and the balances are fairly stated. If the expectation is not getting explained with the explanation that the management is providing, and as an auditor you believe that it is not a logical explanation, then you do further test of detail to corroborate what management is trying to explain or to corroborate the difference that you had witnessed. If it gives you the right result, takes you to a conclusion, it is fine. Otherwise, we look at, and of course, it has to be material. So materiality, which you would have already done in a separate essay, or if there's a separate essay on that, has an overarching impact on all the other audit procedures or evaluations that we are drawing. So if that difference is material enough to say that the balances could be misstated in the financial statements, then you also look at the impact on the audit report of such differences that you have observed as a part of your analytical procedures. So only if it is unexplained and you are not able to corroborate it with additional audit testing procedures is when you look at an impact on the auditor's report for the same. Moving further, so how do analytical procedures assist in forming overall conclusion. And again, these are some of the aspects that we've been discussing. So the auditor shall design and perform analytical procedures near the year-end audit that assist the auditor when forming an overall conclusion. We already discussed that analytical procedures are now pervasive across the audit. So we use the analytical procedures in the planning phase to set these expectations, to look at account captions which require greater effort or time of an auditor. We perform analytical procedures at the year end to corroborate the routine and traditional audit procedures. And we also perform an analysis of overall financial statements after our audit procedures are over. A very common example for that would be an overall analytical review of comparison of current year numbers with the previous year numbers that we perform after we have done our procedures to see if there are variations between the balance sheet or the profit and loss items in the current year versus previous year. So these are certain aspects of analytical procedures that we do through the audit, and with an ultimate objective of forming an overall conclusion, supporting our overall conclusion as to whether or not the financial statements are true and fair and devoid of any material misstatement. Now, we've said that we would be performing analytical procedures, and there could be multiple analytical procedures that we've discussed. So the next step, in this overall scheme of things, or a logical step, would be that we investigate the results of our analytical procedures. So it is but natural that there would never be a perfect relationship between expectation and the end result, and these could vary with each other, and these are bound to happen. The idea or the whole perspective of the standard is that whatever differences are being observed, or whatever variations, exceptions, by whatever name you want to call them, that are coming, are those that the management is able to explain or not? And second, do you have corroborative audit evidence that supports the management explanation or justification? Now, let us look at yield analysis, for example. There is a pharmaceutical company that produces, and in a pharma setup, everything is very regulated. So the input-output ratio, or the yield of a raw material, would typically give you standard results, which means that with 1 kg of raw material of a particular excipient or a drug, you would be able to say, for example, saying a number just like that, you can produce 10,000 tablets with 1 kg of raw material. So that is the yield. Now we are looking at consumption analysis, and we see that in this particular year, instead of 10,000 tablets, we could only make 8,000 tablets. So there is a variation that comes in. So now this is an analytical procedure that instead of just looking at the bills of raw material and looking at the outward gate passes, that how many tablets have been produced, we dug deeper and we said that we would look at how much should have been produced versus how much is being produced. So this is a yield analysis, a kind of an analytical procedure that we do. We see that there is a variation of 2,000 tablets in the particular year. Now we go to the management and see that why that variation was there. And suppose the management tells you that due to certain research and development procedures, there was a testing that we carried out, and because of which certain raw material was used in such particular R&D, which did not result in final products or these tablets being made. So this is an explanation being given. So what was the first step? We said that we would do a yield analysis. This was an analytical procedure. We did the analytical procedure. That analytical procedure gave us an exception or a difference. The difference was 2,000 tablets lesser being produced. Now, this is material enough because it's a 20% variation. So we went back to the management to say that what could be possible reasons of such a variation. So management gave you a response that there was a particular R&D that was carried out during the year, which resulted in lesser production. So then as an auditor, you would look into evidences that whether or not any such R&D was carried out during the year or not. And when you do such an analysis, if you are able to obtain audit evidence that supports the justification or explanation that the management has given, then you conclude that your overall balance of consumption or production or sale is appropriately stated. If it is not giving you a right result, then there is a possible misstatement in the financial statement, which it is our responsibility as auditors to report or to bring that out or perform procedures that can substantiate the end result. Moving further, what could be different kind of, or what could be a nature of different analytical procedures? A very basic one that we always do is compare information with prior periods, which could be looking at what is the increase in sales, is the other expenses moving in the similar ratio as increase in a particular item or not, so correlation between the two. Second aspect could be anticipated results of an entity, such as budgets, forecast, and other expectations that the auditor has. So these would be, so for example, if there is a significant capitalization that has happened in middle of the year, so you would expect the depreciation expense to go up. If there's a significant capitalization that has happened, you would expect the AMC that the company gives to go up. If there's a significant capitalization that has happened, you would expect the insurance cost to go up. Also, a single event of a capitalization, and as an auditor, we have expectation on 3 different account caption: on depreciation, on AMC, on insurance cost. So the moment there's an event, there's an expectation by an auditor, you look at that, are the other account captions moving in a similar manner or not? And if not, then you develop your audit procedures to do an audit of such exceptions. A third basis could be a similar industry information that one can use. So for example, if one is auditing IOC, so then you could use the results of HPCL and BPCL to arrive at your audit procedures that you could use for your own testing procedures. Now, besides the specific things like prior period, budgets, forecast, you could also use interrelation or correlation or interface between 2 different aspects. So this could be interface between financial and non-financial information that we discussed right in the beginning, where a number of laborers could have an impact, number of units could have had an impact. Payroll cost going up would mean that the number of employees has gone up, and similar data that one could use. And one could also use elements within a financial statements that move in a particular manner. For example, if my sales have gone up, my freight expense is likely to go up. If the sales have gone down, the freight expense is likely to go down. Or if I may use a non-financial information, in last 1 year, the dollar has, say, depreciated by 8%. So that would mean that my cost of raw material, which is imported, is likely to go up. So one could use financial and non-financial information which have a correlation or an interface between different items to develop that expectation and then audit such an expectation. So the whole idea is that the first step is you set an expectation. Second step is against that expectation, you bring out, is there a variation in that expectation or not? If there is a variation, then you go to the management for an explanation. You go to the management for explanation, and then you corroborate it either with the already available audit evidence, or you obtain further evidence and decide that whether or not any additional procedures are required to come to a conclusion or not. So, when do you use analytical procedures, and where is the suitability of analytical procedures as per the auditing standard? So the use of analytical procedures could be on any account caption, and it is pervasive. But where is it likely to give you better results is where there are a large volume of transactions which tend to give you predictable results over a period of time. So while analytical procedures can be used and should be used across the account caption, across the balance sheet and profit and loss account, but wherever the volume is high, or wherein you want a greater coverage, and wherever there is predictability, you could better use the substantive analytical procedures for a more effective and efficient audit. Now, different level of analytical procedures provide different level of assurance. There would be certain procedures that would give you to the point response or a conclusion, and which would mean that you'd have to perform very limited additional procedures. For example, if you have a company that is into rental business and you have market intelligence around the per square feet rental, then through an analytical procedure, you could do a reasonability of the overall revenue. So that would give you a very corroborative evidence by just performing analytical procedures. However, if we talk about a gross margin analysis, input-output ratio, yield analysis, now these are very good analytical procedures, but they do not give you a final conclusion. You still have to perform many more additional audit procedures to use that input which comes out of analytical procedures and come to a final conclusion. Goes without saying that the determination of suitability of a particular analytical procedure depends on the nature, timing, and extent of risk assessment of a particular account caption. And also, what are the other audit procedures that could possibly be performed on that account caption or on those account assertions, depending on the risk that you have associated as an auditor with those account captions. So your substantive analytical procedures, to begin with, can be pervasively applied across the length and breadth of your financial statements. However, they are likely to yield better results on account captions or on items wherein there are large volume of transactions and you want to have a greater coverage, and there is a level of predictability involved. And there is a different level of assurance with regard to your analytical procedures. These would depend on the nature of assertion and the risk that you associate with a particular item. And also, you would have to evaluate what are the other procedures that you are performing so that the nature, timing, and extent of substantive analytical procedures can suitably be evaluated. Now, the reliability of data is of key importance, because we are saying that there is an expectation that we are setting, and the effectiveness of your analytical procedures would largely depend on where exactly are you obtaining the data, what is the source of that data. If the source is information explanation given by the management, then of course, it is not that you can't rely on it, but it is not a completely 100% reliable data. Compared to that, if your source is an independent third-party confirmation or publicly available market data, then the effectiveness or reliability of that data is much higher. The second aspect on reliability of data is comparability. How much can you use that data in terms of comparability? Now, one very good example in that case could be for gratuity valuation. For example, there is an actuarial valuation which gets carried out, and as auditors, we are required to look at the assumptions that go into it. Now, assumptions is something that are publicly available. And there is a lot of public inputs or data available on those assumptions. So these are highly comparable. Comparable in what sense? The standard allows the use of government bond yield. So if entity A, whose results are already audited and the information is available in public domain, is using a discount rate of say 8%, and the management of the company that you are auditing is saying that they would want to use 6%, then there is a clear case that they're trying to understate the liability. So you would want to dwell deeper into why they are using information or a data that is not comparable to a very effective, reliable source data available in the market. The nature and relevance, and also last but not the least, the control environment around a particular account caption is also a key input that one would use while determining the reliability of data or reliability of the expectations that you have set up. Stronger the control environment, greater the reliability of data. Weaker the control environment, less. I mean, it's a no-brainer that it would be less reliable in terms of reliability. Now, when we look at variation, do we have to report as auditors on all variation? The answer is no. One would have to apply principles of materiality when you look at a particular variation. Now, for example, your gross profit margin was 60% last year, 58% a year before. In the current year, suppose it comes out at 61%. Is it too much of a variation? The answer is no. But on the contrary, if my packing cost was 3% of my sales and it becomes 4%, so 1% means actually 33% movement in my packing cost, and that is an input that you would want to really delve deeper, dig deeper into, and come to a conclusion. The other thing that one would also see is that what is the absolute amount of variation? Suppose the variation comes out to be 1%, but that 1% is say 20 crores, and the materiality that you have set up for that account or our client or the company is only 2 crores. So it is way above the materiality limit that you have set as an auditor for that account. Then you would have to explain that variation in your audit work papers. But if the variation is only say 30 lakhs and your overall materiality is 2 crores, 3 crores, then you can leave that amount as if it is explained by a justifiable basis and not perform multiple additional procedures on the same. So each variation need not be explained, but variations that are material and that are for important account captions need to be evaluated and further investigated into. So we've already discussed what is the difference that is acceptable is a judgmental call, and one would have to look at materiality and various other factors as to whether or not that requires further action by the auditor. However, that said, if there is a variation which is not supported by management explanation, and that variation is material also, and eventually you are not able to conclude with additional audit procedures, then it would mean that you would have to report that as a part. I mean, you would have to consider that variation while reporting into your audit report. We've already discussed it. Certain examples of analytical procedures would be interest expense against the loan, raw material consumption, sales discount as a percentage of sales volume, rental volumes, trends. So these are certain examples of analytical procedures that we have discussed in last 40-45 minutes. And some more examples could be ratio analysis, which right now are coming directly from the Companies Act. There are these ratios that are to be given. So there is inventory turnover ratio, account receivable ratio, account collection period, and various other ratios that one could use to study the relationship between financial and non-financial items and design your audit procedures accordingly. And some of the source of informations could be interim financial information, budgets, management accounts, other records like VAT returns, your GST returns, your bank and cash records, and various other aspects. So I've tried to cover, though we are right on time, but if there are a few questions that you want me to take through, we can consider those.
Yes, sir. There are certain questions for you. Can you hear me, sir?
Yeah, I can hear.
First of all, thank you so much for wonderful deliberation on this technical topic. So, first question is: in case of amalgamation of two companies, how we have to treat this, sir?
So, amalgamation of company would not be any different from. So, whether there's an amalgamation, there is a demerger, merger, or it's a running company. You have to essentially set out expectations. So, for example, if there's an amalgamation that has happened and there is synergies that are coming through. So, one expectation would be that some of the expenses would go down. There would be additional legal expenses that would be there in the particular year, or it would be fact-based. So, amalgamation per se would not have any impact on my audit procedures from this essay particular perspective, but that's an important event which would give me inferences or evidences to set my expectations while I'm designing my audit procedures.
Yes, sir. Thank you, sir. And what is the importance of analytical procedure in case of the due diligence?
So, see, in due diligence, I think I would say that's, if I use a very layman term, that's auditing from a commercial perspective, wherein you are wanting to make certain decisions basis the commercial aspects of various financial and accounting captions. And over there, the use of analytical procedures is much higher compared to a standard audit, because a commercial decision around sale, purchase, or any other transaction is to be made. So the use of analytical procedures is much higher in case of due diligences compared to a traditional audit.
Yes, sir. There is one question relating to the estimated FS. If the auditor cannot sign an estimated financial statement per se, and however audited financial statement based partly on the estimates of depreciation, provision, etc., can be signed. So how is to be justified, sir?
See, I have not understood what the estimated financial statements would be, but maybe let me answer this question differently. So against each account caption, as an auditor, you would have an expected or an estimated amount that would come through. That could be for depreciation, that could be for my sales, that could be for my various expenses which come out and derived as a percentage of sales. Now, in a perfect world, all my expectations would be coming true and every ratio would yield a perfect result, but that very seldom happens and would never be the case. So as an auditor, it would be your responsibility that you design your audit procedures in greater detail wherever your expectations are not being met. So you would have to spend more time in areas or account captions where your expectations are not meeting, and then come to a conclusion whether the financial statements are devoid of any material misstatement or are presenting a true and fair view or not.
So thank you so much, sir. On behalf of AASB of ICI, I extend my heartiest thanks towards you for sparing your valuable time and acceding to our request on a very shorter notice. In spite of having a very hectic and busy schedule, you acceded to our request, and for this such a wonderful deliberation on SA 520. So on behalf of AASB of ICI, once again, thank you so much, sir. Thank you so much.
Thank you so much, Anil. Thanks.
Thank you, sir. Thank you. So moving on towards the next technical session, that is on relating to the SA 540, auditing accounting estimates, including fair value accounting estimates and relating disclosures. So in order to tackle this, we are having with us CA Pratish Amin ji. Sir, you are there?
I am there. Am I visible?
Sir, now you are visible, sir. Now you are visible.
And
So
am
on
I
behalf
audible
of the
also?
SBO of ICI, I extend my warm welcome to you, sir. I extend warm welcome to you, sir, for sparing your valuable time. It is my proud privilege to share with everyone the brief profile of Pratish Ji. Pratish Ji is a partner with KC Mehta and Company, prior to which he led Deloitte's Baroda office external audit practice and had been with Deloitte for over 15 years. He has experience in the audit under IFRS, US GAAP, due diligence, review for takeover propositions for strategic alliances and for spin-off units, advisory services in connection with IPO, management internal audit, statutory audits under the Indian Companies Act, and advisory services in connection with the share valuation business setup. He has been on a short-term secondment on Australia and has on just-in-time programs to the United States and the United Kingdom. He has also provided audit and assurance services under US GAAP and IFRS. He has wide experience in different business segments like manufacturing, automotive, chemicals, engineering, oil and gas, construction. He is the Bachelor of Commerce from Maharaja Suyat Raji Rao, MS University of Baroda, and he's the Associate Member of the Institute of Chartered Accountant of India. So welcome you, Pratish Ji, once again. So without wasting much more time, I request Pratish Ji to please deliberate on the topic. Over to Pratish Ji, please.
Thank you for the generous introduction as such. Let me take it forward from here and not spend much time on other things. We'll probably do it later point in time at
Yes,
the end
sir.
of the session if we do have time available. I'll share my screen in the first instance. Just tell me if it is visible or not. Is my screen available?
Yes,
Visible?
yes, it is visible, sir. Make it full screen, F5. 100%. Yes, sir.
Okay. Okay. This is, let me tell you one thing. I have actually, gathered the material which is available, which is made available to us by the institute in this regard, and which is publicly available as such. The institute has put up, you put up different sources of material in terms of multiple choice questions, in terms of ready references, in terms of the presentations itself for all the standards which are there and which is put up on the website. So this is publicly available information which they have shared across, and they've done a wonderful job of it. So I have not tried to, reinvent the wheel by making a presentation on it, which is very much available. I had tried to bridge the gap as far as possible. If the material is available, what is it that we require to do in terms of implementing it? Now, let me come back to this in the first instance. This SA 540, the full form of the standard is basically auditing accounting estimates, including fair value accounting estimates and related disclosures, which you're able to see in the front of your screen. It was effective from April 1, 2009 year. Okay. I'm sure this 48-page document, many of you would have read it. Many would have referred it whenever you are required to do so as such. So will I go through the entire standard as such as it is? Definitely not. But this is a standard which I just kept up, which is publicly available from the Institute's website on the EQSCA standards as such. Standards on auditing. This is a standard on audit evidence, the 500 series. Now, as you are aware, or you would be aware, that SA 500 series, there are certain standards which have implementation guides. This is one of the standards which does not have an implementation guide, as well as 520, which my co-faculty picked up earlier, Mr. Amit. That also does not have an implementation guide per se from the Institute of Chartered Accountants of India. Not to say that there is no implementation guide or tools available elsewhere, which I'll definitely try and cover, because our intention, as I understand, is how to implement and apply the standards which are there. Basically, understanding of the standard, I'm sure everyone has it. If not, you can ask me a question at any point in time or later at the end of the session. I'll be more than happy to answer that. But I am presuming everyone is gathered out here, to be knowledgeable about the implementation part of it rather than the standard per se. Okay. Now let me at least take you through first instance what is the material available. These are MCQs on this SA 540. Institute has come up with these MCQs. Let me present you the first page. Multiple choice questions on EQCS basically, sorry. So you can go through this multiple choice questions, which was done as recently as July 2020. No major change in the standards after that, and particularly nothing in SA 540 and many other standards also as such. So this is a good reference tool for us to actually check and gauge our knowledge and our understanding of it. When you can take an MCQ, there are answers or responses at the bottom, at below, or at the last page of this document, right? But prior to that, you can actually test yourself. You can gauge an understanding as to where you are, and depending on that, you can deep dive as to the specific standard or even the specific sections of the standard, as the case may be. Okay. Then this is the other material which has been made available by the institute. This is publicly available. Let me tell you, all of these things are put up by the institute on its website only. This is background material for audit training workshops and seminars. This is a very good document prepared by AASB as well. I need to give it to them in that sense, and it is updated up to October 2019, October 2018. I can just take you out there. Yeah, October 2019. It is pretty much a recent document as well, updated up to that time. Are you all able to see my screen properly? Anilji?
Yes, sir. It is visible, sir. Background material for audit training workshops.
Yeah. As you can see, this is material available. I can provide the links to Anilji. I'm sure he would already be readily having it in terms of this ASB material as such. So I'm not picking up anything which is not publicly available. I'm just picking up the public available material. So this is background material. This has in the form of a PPT, presentations of all standards, not just SA 540, which you can refer to, right? Even if you don't have the time to make your own, there is a good amount of material which has been made available. I would like to profusely thank ASB for doing this job and making it easier for all the professionals or independent practitioners to actually practice and implement it easily. Then there's one more other document, ready reference on engagement and quality control standards. This is as recent as December 2019. Again, like I said, no major change in the standards after that. At least SA 540, the standard which I am talking about, no major change at all. So you can refer to this material also. This will give you a 3-page or 4-page summary of the entire standard. Just a 3-pager or 4-pager. In some standards, it may be a 5-6-pager, but that's about it. A crisp 4-page summary of what the standard requires you to do. Okay, so I will run through this only. This will be my sum and substance of what I'll be presenting today. So this, again, like I said, this is taken right from the background material available. This is only extracted for the specific SA 540 material. Otherwise, the entire background material is available here. As such, it's a 514-page document. It contains each and every standard presentation. I am using the same for SA 540. Okay. Overview of SA 540. The introduction, scope, effective date, objectives, definitions, requirements, and the application and the other explanatory material. Like I mentioned, there is an application material which has been stated in the standard itself, but there is no implementation guide for the standard, as is available for 560, 570, let's say, right? We know that there is an implementation guide available for going concern subsequent events. There's also for an audit sampling. There are for other standards also, standards on audit evidence, as well as planning and risk standards, risk assessment standards, basically the 300 series. The scope, again, scope is basically auditor's responsibility in terms of accounting estimates, fair value estimates, as well as the related disclosures. So what is your scope? Ultimately, like I said, this is a standard on audit evidence. The standard on audit evidence always has to have a linkage with planning and risk assessment standards. It can't have it can't be an orphan in that sense. It always had to have a linkage. So on the right hand side, if you look at the box, it contains application of SA 315 and SA 330. 315 is, as you all are aware, assessing the risk. 330 is responding to those risks, right? So I'll not obviously get into those standards in far more detail than what is required. But nevertheless, you are aware, and that material is also available in the background if you want to refer to, as well as the ready reference. And if you want to test yourself also, or test your team also, that they are up to date, you can give them the MCQs also and go through it in that sense, which will make it easier. In addition to the entire standard, this is not a substitute for reading the entire standard, mind you that. It's only once you're done the job of reading the standard and you still want to simplify, you want a shorter version to refer to, then this is a very good material available. Okay, so requirement and guidance on misstatements of accounting estimates, an indicator of possible management bias. Now, what is an accounting estimate? The accounting estimate is pretty simple, simply worded. It's a approximate of a monetary amount in the absence of a lack of precise measurement. That's how it is defined as such, right? As you can see, FS items that cannot be measured precisely but can only be estimated. There are many such that we come across every now and then. Single thing like a useful life or a depreciation, that being the simplest thing, that's also an estimate. As far as impairment considerations are concerned, those also involve estimates. As far as fair value is concerned, those also involve estimates. As far as provisioning for doubtful debts or expected trade loss, as far as index is concerned, those also require estimates. So there are many areas where estimates are required. So the outcome of an estimate may be the monetary amount that we recognize in the financials, or we may be disclosing it in the financial statements. But there are estimates involved. So now measurement objective for some of the accounting estimate. It will all depend on the measurement objective. Now, to give an example in a short form, I'm not going through the each and every line item as such. I'm just going to give you my thoughts on this. The presentation is all available. The text is all available. The ready reference is all available. I'm sure you'll be able to go through easily. And you, most of you, I presume, would have already gone through it. So I will not belabor the point on that front. I'll assume that you have already seen it. Let me get back to you in terms of what is more relevant and contextual in terms of implementing it. So measurement objective, what is your measurement objective? If it's matter of litigation, let's say, you're more interested in knowing the range of outcomes of the transaction or the event or the condition, not necessarily the monetary amount. The monetary amount will definitely be involved because you have to recognize something, or you may not have to recognize, you may have to disclose, as the case may be. But out there, you're more interested in knowing the outcome, whether the probability of your winning or the likelihood of your winning is higher, lower, or the range of outcomes. If you win, then what could be the outcome? How do you win? How do you lose? Or what is the extent of that you might have to pay out? Those sort of scenarios. So there you're more interested in looking at the different or the varied scenarios and what are the scenarios that would be the most probable ones to occur, right? So that is where the measurement objective depends. Then there are fair value estimates. Where we want a fair value for index purposes, let's say, then you're looking at the monetary amount itself. You're looking at the amount that is being worked out more than the outcomes. You have no major outcomes to note of. It's specifically the amount that you want to look at. Okay. So again, if there are outcomes which you have considered, you have assessed, depending on the information available at the point in time, and that outcome does not come out to be true as you expected it to be, that necessarily or by itself does not mean that your assessment or your accounting estimate was wrong. I'm sure all of us are aware of this, but I am re-emphasizing and restating that is what the last sentence is all about. Difference between the outcome of an AE, which is the accounting estimate, and amount originally disclosed in financial statement does not necessarily represent a misstatement of financial statement, particularly for fair value accounting estimate. Because as we are all aware, it's an estimate. Estimation involves approximation. It is not precise. It involves uncertainty. Moving forward from here, there's a good amount of material text available below. You can refer to. What are the examples? Let us look at the examples. Some of the examples the chairman gave us in the starting session itself. Before the session started off, allowance for doubtful debts, inventory obsolescence, warranty obligations, depreciation method or useful life, provision against carrying amount of investment, which is impairment in terms of financial instruments or financial assets, diminution, if at all, if you would like to say other than temporary, outcome of long-term contracts, right? Financial obligation or cost arising on mitigation settlements and judgments, legal outcomes, litigation outcomes, all of this are estimates that you're undertaking. Then what are fair value accounting estimates? Examples, complex financial instruments, you got most companies have this investment in unlisted equity instruments or other instruments which they have, and you like to have a fair value for it. If it's fair value through OCF, fair value through PL, as the case may be, unless it's a subsidy and all this thing where you're taking a cost basis as far as index is concerned. So those also would have a fair value accounting estimate. It may be a complex accounting estimate. It may be a simple accounting estimate. That's a matter of detail that we'll get into in terms of what the procedures would be, in terms of risk assessment, in terms of identifying at the assertion level, then our response to it. Okay, share-based payments, property, plant, equipment held for disposal. There, obviously, you require fair value to bring it to non-current assets held for sale or disposal, as the case may be. Current assets liability in case of business combination, goodwill, then transaction involving exchange of assets and liabilities as such. All of this have fair value, accounting estimates requirement. Objective is very simple. You're supposed to, as an auditor, your responsibility and obligation is to see that the accounting estimates are reasonable. Accounting estimates including fair value. Wherever I'm stating accounting estimates, please read including fair value estimates. If it is not, I will tell you separately, but are reasonable. That is what you're supposed to look at. And the disclosures are adequate. These are the two objectives which you have. So, objective is very simply stated, but in terms of the work that is required to be done to fulfill those objectives, to meet those objectives, is very detailed. Definitions, again, accounting estimate, approximation of a monetary amount in the absence of a precise means of measurement. Okay. Now, what is the responsibility of as an auditor? You have gotten the objective. Then what do? It is obviously the management's responsibility to come to an estimate. First instance, they are the ones who are supposed to build up an estimate, derive an estimate, come to an estimate which is to be recognized or to be disclosed. That call, that judgment is obviously the management's. Then what are you responsible for it as an auditor? You are supposed to validate that. How do you go about validating it? You actually try and build up your own estimate, point estimate or a range of estimates, where any estimate in the range would be probable, would not be wrong in that sense. I'm using lay words as of now, not complete terminology, for the simple reason that I can get forward from here. That's why. Then there's estimation uncertainty involved clearly. You look at the uncertainty around those estimates and how it impacts the estimates. If the sensitivity to those factors, variables, that is what you need to factor in, consider. And you try and work out scenarios, you try and work out the best range possible if it is not a point estimate, if you can only come up with a range estimate in that sense. Then there's a management bias. See, the standard presumes basically, even if you don't intend to have a management bias, you may unintentionally also you may have a management bias. So that is something that you look out for, obviously. Whenever there's an accounting estimate and when it's a complex accounting estimate and that estimate itself is material to the financial statements or financial reporting as such, you definitely have to be more concerned about it, more focused on management biases. Even understanding of the biases, the source of bias, where it could come from, the possibility of a pressure that they may be undergoing through an IPO process. The company wants to come up with an IPO, raise capital from the banks, probably. They want to meet other objectives. If we have an understanding and idea, probably we may be able to, home in on what sort of a bias could be there. Bias by itself at an assertion level, it is very difficult to make out and tell. It is in combination of other factors only you'll be able to say whether there's a possibility of a bias or not. But you need to do your work around finding out if there's a bias or not, at least confirming to yourself that this does not suffer any management bias in that sense. Then management points estimate. Like I mentioned, it's the management who's supposed to actually come to a conclusion or derive an estimate as such, right? So management's points estimate, that is what you're going to be auditing. Obviously, you're going to work out your own estimates also. So then you compare and you find out if there are any differences, then what are the things that you're supposed to look at? What is the management taken up? You look at all those factors, whether it has been considered appropriately by the management, whether the factors that you've taken in considers what the management has considered and all others also. That's how it is. Outcome of the accounting estimate. These are the actual monetary amounts which will be recognized in the financials or maybe disclosed in the financial statements, right? So accounting estimate is the process itself. You will ultimately come to a monetary amount. You definitely are trying to come to a monetary amount as far as possible so that you can recognize in the financials if it is to be recognized or to be disclosed as the case may be. Now, there are slides out here. I'll not take you through one by one each and every slide. Just to make it shorter, you have to perform your risk assessment procedures. So just let me take you to one other document which is available from IAASB. This is the International Auditing and Assurance Standard Board. Obviously, as Indian Auditing and Accounting Standards Board, Auditing and Assurance Standard Board, let me correct myself, is also in sync as far as the SA 540, which was on an extended basis. IAASB has revised ISA 540. There it is ISA 540, which we have SA 540, International Standards in Auditing. But to great extent, the material which has been put up by the IAASB can be used by us as professionals. Much of it can be definitely used, and much of it can be taken as an implementation tool, if not as a guide completely. It is not a guide available from ICAI per se, but it is definitely an implementation tool which you can consider while actually performing your work around estimates in your own Indian scenario, right? So these are the linkages which they are given. The linkages are also given in the background material and the standards per se, but this is a diagrammatic flow, and this diagrammatic flow is also publicly available. I'm taking all the documents which I show you are publicly available for anyone and everyone to access. Nothing which is on a paid basis, which I can put up here, right? So IAASB, it gives you a linkage of the SA 315 with SA 540. You obtain an understanding of the entity in its environment, including the entity's internal control, for the purpose of identifying risk of material misstatement, basically. That is what SA 3150 requires us to do. So SA 3150, how do you apply it? How do you implement it? You got SA 540, SA or ISA 540 out here, right? Which will tell you as to what your responsibilities as an auditor is. Then you find out, first and foremost, it is risk assessment procedures and related activities. Then you identify and assess the risk at the assertion level, which is the risk of material misstatement. Then you go down below, which is response to the risk. Everywhere they have given you the linkage, right? So you don't need to scratch your head in terms of trying to understand. Obviously, you can read all the material and you can draw the linkages on your own also diagrammatically, but this is readily available, which you can refer to. And I always have a principle in mind in that sense: if it is already invented, do not try and reinvent the wheel. And if it's publicly available, put out everyone else to refer to, then you should definitely use that for your and use it to help yourself, and make it easier and faster for you to implement certain things. So response to the assessed risk of material misstatement and overall evaluation based on the audit procedures performed. So again, like I mentioned, this is a public document available. I will not bother you with the details, with the linkages. You and I both know there are linkages available, because this is a standard on audit evidence. Just like SA 520, SA 530, 550, 560, 570, all of those are audit evidence standards, 500 series. But that itself is a subset of what SA 300 will ask you to do. That is how we need to go about it. Again, IAASB has also put up one-pager chart, or two-pager chart rather, diagrammatically. We have a presentation from the institute, which is a well-done job in terms of SA 540 completely listed out. This is a one-pager document for you to refer to. Make your life easier. What are your responsibilities broadly? Again, there's one more document which has been put up by IAASB, which is the testing approaches. How do you go about testing? What are you testing? Okay, now here let me point out this to you. This is like, as you would have seen, ISA 540 revised. We don't have the revised SA 540 in the Indian context as of now. ISA 540 was revised on account of IFRS, fair value, ECL, and all those things coming in, and many other complexities coming in. So they have addressed it through the ISA 540. I am not privy whether our AASB is also working on an exposure draft, which will probably be in line with the revised ISA 540 or not, or whether we expect it to not. But broadly, the principles remain the same. It's only certain enhanced guidance which is available in ISA 540, right? But you can definitely use this material as tools available in addition to whatever the institute has already put up. So that implementation tools support is already available both places. The institute has given, as well as IAASB has also given that. Okay, I have tried to bring in that these are all materials available. The testing approaches, these are one-pager, two-pager document. I can take you through it, and probably taking you through each and every box, I bore you, and probably 60 minutes would not be sufficient enough time to do proper justice to it. But you can go through the entire document, and probably if there's any other session where we are getting into details of this, case studies or other implementation guide, which is longer than 60 minutes, we can do a proper, better job on that front. But I can definitely highlight to you all that is available, which you can refer to in that sense. Okay. Now again, this is the 4-page document from the ready reference. This, this is like a précis or a précis of a précis. A 48-page document out here, SA 540, has been brought down to 4-pager. The main objectives. Obviously, you definitely have to read SA 540 and know SA 540 completely. But this does a very wonderful, marvelous job of summarizing the entire standard as such. And again, this is available on the institute's website, prepared and put up by the institute for the members as such. So there's a good amount of material available here. Very simply put, okay, I'm just taking you through it. So whenever you get the chance, and this is not just for SA 540, this is across for all standards. All standards. The presentations as well as the 4-page or 5-page summary document is available for all standards. Again, moving forward, you are supposed to conduct risk assessment procedure and related activities. Then you go forward, you identify risk at the assertion level. So you have to identify risk of material misstatement. In the process of identifying the risk of material statement, you may come across something as, or identify something as a significant risk, or you may not. If it is a significant risk, there are other detailed procedures which you're supposed to or required to perform. If it is not a significant risk, then there are procedures which are required to be performed, not as detailed as significant risk, but you're required to perform. This standard, this presentation will also lay down all of that. Okay. I can take you through one by one, but I'll be bored. It's already given. Let me take you through this document. It will make it easier. First and foremost, if you look at the left-hand side, risk assessment procedure and related activities, we have the similar thing in SA 540, or they extend ISA 540, as the case may be. What do? You obtain an understanding of the entity, which is the 315, including its internal control, identify risk of material misstatement. You perform a retrospective review. Retrospective review would mean, in the current year, let's say if I am performing the audit for 21-22, I would look at the estimates made for 21 also. You do a retrospective review and find out how reasonable were those estimates at that point in time based on that data, or how true it turned out to be later, or how off were you, basically. I'm putting in very layman language. How off were you? How near were you to that? How near was your estimate to the actual thing? That is what you're trying to look at. So you can improve the process, you can improve your procedures, you can improve your methods, data, assumption, whatever be it, in that sense. So determine whether you require a specialist or not. Some accounting estimates may require to do so. Primarily in oil and gas industry, in many other industries, you require experts in that, specialized skills. All right, you may not be able to do it on your own. Some places, actuary services, obviously in Indian context, actuary valuation is taken out from outside of the firm, outside of the organization, and that we rely depending on the SA 600 series as such. Basically, management expert or internal auditor, whatever be it, whatever accounting estimates are required. So actuary estimates are based on the actual reports per se. So we are relying on specialized skills, but not our own firm providing it probably, or our own professionals as the case may be. Then you go and identify risk of material misstatement at the assertion level, which is to say at the account balance level, at the presentation disclosure level, basically. Material classes of transaction, so as to say. Now you identify the controls around it, how good the controls are. In the new ISA 540, I'm comparing this also because this is something which it may come in, it may not come in anytime soon, but the principles which they talk about are relevant in terms of your understanding of how to look at estimates. You may not directly use inherent risk in the SA 540 framework currently, but the inherent risk which has been brought into ISA 540, the revised, is as relevant in terms of understanding the concept, right? Not so much in terms of implementing SA 540 or complying with SA 540. But definitely, in terms of when you do your work around the estimates, it's good to have an understanding of inherent risk and all those concepts, which is an improvement in that sense. Okay. You determine whether there is any identified in assessed risk of material misstatement, ROI, double. Then if you say there's a significant risk, then you go to this next para, where the next column as such. And if there's no significant risk exists, then you go to this part clearly. Similarly, you do all of that process, then you respond to the risk. Once you identify those risks, you respond to the risk. It may be based on whatever you may want to perform test of controls. You may have an inherent assurance, right? After you looked at all the framework and the entire thing, you may have an inherent assurance. You may have a control assurance that you may have planned. Thereafter, you may go in for a substantive assurance. Substantive assurance may be on a different type test of details primarily in terms of procedures. You may not be able to perform analytical to great extent, may not be, I'm saying, depending on case to case basis, circumstance, or even for that matter, substantive analytical procedures on an overall basis, you may not be able to perform as as you would be able to do it through test of details, basically. Okay. Then there are testing approaches which have been given. What do? You obtain audit evidence up to the date of the audit report. Now, here is something which someone might say, why not up to the year end? You're supposed to look at the audit evidence which is available up to the audit report to consider your audit accounting estimates per se and provisioning, not just up to 31st March 22. So if you're signing off probably with May now, then you need to definitely factor that and consider that. Not to hindsight it, but to gather the evidence that may be available later on. Just like, what IAS 10 tells you, or India's 10 basically tells you reporting periods, events occurring after the balance sheet, considering all of that, but nevertheless, this is for the auditors, basically. Test how the management made the accounting estimate. Obviously, the testing approaches have been taken up in the separate diagram, separate flowchart that you can look at it separately. You develop an auditor's point estimate or a range. You just don't know what the management has said. You build up expectations. You build up predictable relationships. You will build up plausible relationships, and you try and develop your own estimates, right? There may be some estimates which you may not be able to work out, but that is where you have to factor in whether you require a specialist of your own to work that out. Or is it the management's estimate that you're going to go by? Then how do you go about it if you're not going to be developing your own estimate, right? Typically, you would develop your own estimates, or you may use your own specialist, or you may use outside specialists or management specialists, basically, depending on the situation, right? So again, after doing the entire exercise, there are disclosures. Like I mentioned, accounting estimates are reasonable and disclosures are adequate. That is the objective. So disclosures, obviously in India, if you would have seen critical judgments, management estimates, estimation uncertainty, high estimation uncertainty, that's a section as far as India's financial reporting is concerned. That's a section which is required to be presented on by India's one presentation of financial statements. In the Indian GAAP, non-Indias, basically, we don't have such a requirement per se, but we do have an understanding that this have to be disclosed appropriately. If something is relevant to the understanding of the financial statements, basically, then you need to appropriately disclose it. The disclosure in terms of the uncertainty involved, the risk involved, the uncertainty in terms of high estimation uncertainty, low estimation uncertainty, all of those disclosures would help someone, reader of the financial statement, to come to a conclusion in terms of how the accounting estimates have been worked out and how sensitive the financial reporting may be to such estimates, right? So that is what it is. Management bias is something that you look at after considering the estimates that have been worked out. You look out for indicators of possible management bias. There is nothing which has been taken that there is a management bias, but indicators are possible. Again, not just at the assertion level, it is very difficult to work out at the assertion level per se. You need to look at it and combination of factors. Consider many of the things, then find out whether there is a possible management bias. Then after you've gone through this, you evaluate based on the audit procedures performed, whether the auditing estimate is reasonable. The procedures or the estimates have been determined on a reasonable basis. The assumptions taken, the methods taken, the data taken, the models used by the management is reasonable. Okay, you take written representations and you have to communicate also Now, communication with those who charge with governance, with the management, obviously, and other relevant parties as may be appropriate. Typically, estimates are by and large communicated to the audit committee and the board also through our audit presentations, audit committee presentations, or to the board also. And we highlight the key estimates definitely, in addition to the other estimates also, which are relevant in the financial reporting, in the preparation presentation of financial statements. So, and if there are certain key estimates during the year, right, you may want to highlight that clearly, you may want to discuss that, you may want to take it up to the audit committee and highlight the management process and even your own process as to what you've done, and so they can also take a proper view of it in that sense. So this is the document as far as the chart is concerned. This is the same thing out here in SA 540 in detail out here. This is a very wonderful document which is put out by the institute. I cannot belabor the point. I cannot re-emphasize, reiterate more than what I am doing. It's a very good document for every one of us to refer to, right? In addition to ready referencer, which is a 4-page document. So you can ask someone to go through it, understand it also clearly, use this chart. And again, let me take you to some of the tools which are available. Implementation tool available on an international basis. Institute has not come out with an implementation guide as far as the standard is concerned, but you can use this as an implementation tool available and put up by ISA 40. It is also given you illustrative examples, simple and complex illustrative examples. Again, let me re-emphasize and reiterate that this is with reference to ISA 540, the revised one. However, revised in the extent, there are certain enhancements which have happened. It does not take away from what was already there earlier. And ISA 540, the extent one, and the SA 540 are coterminous. It's pretty much the same. No major difference out there. So you can use this reference point, starting point, implementation tool, right? They are given you examples. What do you do if there's a simple accounting estimate, provision on inventory impairment? Let me take you through one of the examples so that, we are not just talking about it theoretically. This is an example of a camera manufacturing company. It produces camera for professional enthusiasts and consumers. Okay, so professional cameras are obviously expensive, and they have a customer base, steady customer flow and steady customer base. As far as consumer cameras and enthusiast cameras are concerned, their prices will vary differently, variably. There are many models available. There are many models being launched. There is a lot of competition within the traditional camera companies, as well as there are camera companies are facing the onslaught of mobile phone cameras, built-in cameras. Now, who owns a camera person? Except for professionals. By and large, consumer camera, I have not seen it for a long time, anyone purchasing it also, basically. Its mobile camera is sufficient or good enough for our regular day-to-day affairs. And that is what is being used. So this is a camera manufacturing company. Now it has to take a call on its provisioning for impairment of inventory or lower of cost or NRV, whichever is lower. Ultimately, it'll come down to that, but you're looking at the impairment considerations. So how do you go about it? This is not very complex as such. It's a simple thing, but in terms of assessing, what all do you assess? This entire document gives you that. Okay, they're giving you 2 examples. The same sort of a company in terms of impairment of PPE, and there's the impairment of inventory. Impairment of inventory typically is not very complex. Impairment of property, plant, and equipment is a complex matter, depending on case to case. And here it is taken as a complex matter, and they've given you an entire example, illustrative, how and what they will understand. They have conducted risk assessment procedures. They've taken the entire paras and they put up the auditor's understanding and approach. I thought this is a good tool which can be readily used by people, which can be readily used. And this is an example which has been given to you. If you look at the example, if you go through the example, it'll clarify the entire thing. I don't need to go through the entire document because the entire document is large. As you can see, it's running into pages, even simple determination. It's a simple accounting estimate for inventory, but it's running into pages. And if you come to property, plant, and equipment impairment, that again runs into different pages. You may do such a detailed analysis. You may not do a detailed analysis. You may can do it summarily, probably in your client case. In your circumstances, you may be able to do it summarily. But if you have to do a detailed job, this highlights and illustrates how it is to be done. And it's a very good document which you can refer to. I have referred to this document. We use it to a great extent for the matters that we handle. And it's a good document which we should be using. Yeah, I'm giving you reference of this document as a implementation tool which may be considered by you for your use. This is the start page of the document. ISA 540 revised implementation, simple and complex illustrative examples. Again, this is a publicly available document, right? It is available to everyone. Similarly, IFAC implementation. This provides you the entire implementation too. Flowcharts that we looked at, the steps required to be performed, the flowchart of the 3 testing approaches. Okay. Again, let me reiterate again and again. This is not SA 540. This is ISA 540 revised, where there are certain enhancements even to the extent ISA 540. Our SA 540 was pretty much coterminous with ISA 540. There are enhancements which are coming, but those are enhancements more than anything else. Okay, but so you can definitely use this material and implementation tool available. It provides you the entire steps out here. Right? So all of this is available. They have put up illustrative examples for ECL, expected credit loss also. Okay, that is also available in addition to the simple and the complex illustration given as far as impairment of inventory, impairment of property, plant and equipment is also concerned. But that is a 92-page document that may be relevant in terms of banking, NBFCs and all those industries more as compared to other industries or some of the industries. Some industries, some companies may have relevance to that. You may refer to that. It is available publicly. Again, coming back to SA 540, these are our presentation slides. The sum and substance, again, objective is whether the accounting estimates are reasonable and the disclosures are adequate. For that matter, the management is supposed to take responsibility, or the management is responsible for the accounting estimates. We are all aware of that. Then what are our responsibilities as auditors? Our responsibility as auditors is to verify the management's estimates, the process that they use, the methods that they use, the procedures that they use, the assumptions that they've taken, the data that they use. That is all which we have to look at. We have to work out our own estimates, point estimates or range of estimates as the case may be, and see the management estimate and the estimate that we have derived or worked out. If it is in sync more or less, then you're okay. If it is not, then you'll have to do other steps, procedures that you need to perform to find out what is missing, either in the management or either your side. What is it that you're getting it right, wrong, as the case may be, and who needs to work it or rework or redetermine as the case may be. And finally, if you do have a disagreement, how to take up those disagreements, that is also later on another standard. I not belabor with that point out here. But if there is difference, you obviously will need to discuss with the management. You might have to take it up to the audit committee and the board level in a few cases. If the management does not agree with you at the first level. Right? So evaluating the reasonableness, indicator, possible management bias, all of this is available out there. What is presented out here in this slide is a detailed presentation of what is there on a 1-page or 2-page document. So this is what I wanted to leave the thoughts with everyone. So I tried to curtail and crunch up my time in that sense and be ready for questions as the case may be. So Anilji, if anyone has questions, I'm more than happy to answer that. And this material links I will be able to share with you separately. Anyway, it's public documents and I showed you the first page itself, the name of the document which is available. So everyone can refer to. And anyone has specific questions, I'm more than happy and available to answer those questions anytime that they have. Are you there, Anilji? Hello. Anyone has questions on that? I am through with the presentation. Basically, this is what I want to leave the thoughts, because 60 minutes I can present you this, that there's a host of material available. 60 minutes may not be good enough for me to actually take you through even a case study completely, all the way through. But as you can see, there's a good amount of material available, and which can be used directly, with some minor changes and all those things. Anilji, are you available?
Yes, sir. I'm here only, sir. Thank you so much. Thank you so
Anyone
much,
has any questions? I'm more than happy to answer that.
sir. It was really, really, really very fruitful deliberation, sir. And you have covered a lot of things while your deliberation relating to the auditing, accounting estimates, including fair value. And thoroughly, frankly speaking, I have gained a lot through your deliberation, sir. Thank you so much for sparing your valuable time and enlightening all of us on the various intricacies on SA 540, sir. Thank you so much, sir. Due to the technical glitch, we are unable to fetch questions right now. But whatever the questions we will receive, I will forward it to you through mail, and we will answer to the concerned member, sir.
Definitely. I'm more than happy to do so.
Yes, sir. Hopefully, we will receive, because technical team is doing its work. If we will receive the questions, then we will forward it to you, and the answers given by you, we will forward to the concerned member, sir. So
Right.
once again, sir, thank you so much for this wonderful deliberation. More than 3,000 members are live here. So thank you so much on behalf of AASP of ICI for sparing your valuable time. Thank you so much, sir.
Thank you.
Thank
Thank
you.
you.
Thank you. Thank you.